The first type of adjusting entry that we will learn is accrued revenues. Accrued revenues are revenues that are earned but not yet received in cash. Examples of accrued revenues are rent, interest, and services performed. Here's a timeline that I created to give you a visual of this type of entry. I have January here at the beginning and December at the end. Usually the timeline for these transactions are not this long, but I wanted to over-exaggerate the timeline in order to give you a better understanding of this topic. First comes the action, which would be making the sale. We would either sell the product or perform the service. This is when we recognize revenue. At a later date, we will receive the cash. When it comes to adjusting entries, the revenue or expense recognition is the most important part, not the cash part. The adjusting entry will involve debiting a receivable account and crediting a revenue account. We are debiting a receivable account to show that we are owed money. We are crediting a revenue account so that the revenue is included on our books for this time period. For all of the adjusting entries that we will be journalizing, it will involve either a revenue account or an expense account, no cash accounts. Let's practice this. This is number 2 on your classwork. At year end, the company has earned but not yet recorded $390 of interest earned from its investments in government bonds. What is the adjusting entry on December 31st? For all of our adjusting entries, they will be made on the last day of the time period before the financial statements are prepared. If you would like to prepare financial statements every month, then adjusting entries will need to be prepared each month. In our examples here, we will be using a 1-year time period. The date for all our entries will be on the last day, which will be December 31st. Remember, we need to debit a receivable account and credit a revenue account. We have been using accounts receivable prior to this chapter, but let's be more specific with this example. We are owed money, but from what? An accounts receivable is usually when a customer owes us money, but what are we owed here? We are owed interest. The account we will be using is interest receivable. How much are we owed? We are owed $390. The credit will be for a revenue account. What type of revenue are we earning here? We are earning interest revenue. The account name will be interest revenue. The amount is the same of $390. This might look a little confusing, but this is the same entry we learned in Chapter 2. We are just more specific with the account name. Other examples could be a rent receivable and then rent revenue account. We can also use accounts receivable and a sales revenue account as well if we made a sale and we're waiting to receive the money from our customers. The next accrual is accrued expenses. These are costs or expenses incurred that are unpaid. We did this entry last chapter as well. We used an expense and will pay it later. Examples include taxes, interest, and salaries. Here is the exaggerated timeline again. We first use the expense and thus will record the adjusting entry here. Later, we will pay it. Remember, we are concerned with either the revenue or expense entry, not the cash entry. The adjusting entry will involve debiting an expense account and crediting a liability account. We are debiting the expense account to record it as an expense during this time period. And we are crediting a liability account because we now owe that debt and will need to pay it in the future. Number 3 on your classwork states, at its December 31st year end, the company owes $250 of interest on a line of credit loan. The interest will not be paid until sometime in January of the next year. What is the adjusting entry on December 31st? Here we owe interest. It has incurred on our bill, but we will not be paying it yet. Remember, the date will be the last day of the time period, which will be December 31st in our examples. The entry for accrued expenses will be a debit to an expense account and a credit to a liability account. What is the expense that we have here? It's interest expense. How much interest incurred during this time period? $250. Next, we need to credit a liability account. Usually we use the same name. If it was interest expense, then we use interest payable as a liability. What do we owe? We owe interest payable. The amount of $250 is the same. For these last two examples, we used interest, but does not have to just be interest. Other examples could be tax expense and taxes payable, or salaries expense and salaries payable, and so on. These are the two entries for accruals.